I just want to make it completely clear that this is what I would do from my own personal learnings, from my own personal experience. You are not required to follow it or anything like that. Ultimately, it's your own money at risk here. You are responsible for what you do with it. So please do your own research, because I am not a qualified financial advisor. So I have a few notes here. I just want to make sure that I cover everything. I want to make sure that you guys have a good understanding of what investing is, because obviously this is for beginners. So why should we invest? Number one is saving money. Number two is letting your money work for you. And number three is tackling inflation. So editor Ollie here. I completely forgot to mention, one of the reasons why I even made this video was because I had shared a screenshot of my portfolio on Instagram and Twitter. And obviously I showed how much percentage gain I'd made over the last 3 or 4 years. And because of that, a lot of you had questions about investing, how to invest, what to do with investment, stuff like that. And it's what spurred this video in the first place. So let's get back to the video. So we'll first start with tackling inflation. So for those who don't know what inflation is, I think a lot of people do know what inflation is, but essentially what it is that the value of money decreases as time goes on. The buying power of money decreases as time goes on. So leaving money in your bank account and not doing anything with it, not putting it into savings, not putting it into investments, just leaving it in your bank account is a terrible idea. It really isn't a good thing to do, because your money is essentially losing value. There are quite a few factors that go into inflation, or why the cost of things go up, whether it's salaries going up, the cost of making things go up, just generally the price of things go up, and that's why the value of money decreases. You may have noticed it yourself over time. Maybe your favorite chocolate bar or something like that when you were buying as a kid, maybe it was like 50 cents. But now when you're older, maybe it's $1 or $1.50 or something like that. That's what inflation essentially is. The item itself is the same, but now 10, 15, 20 years later, that item is more expensive. There's also something called shrinkflation. So shrinkflation is when you're paying the same dollar amount for something, but the amount you're getting for your dollars is decreasing. I've noticed this a lot when it comes to fast food. So I remember when I used to go to like KFC or McDonald's, for the money I used to spend, I used to get quite a lot of food. And then as I got older, I had noticed that the amount of food I was getting for the money I was spending was actually less. And now the food is still getting less, but the price is going up even further. So inflation has been an absolute killer when it comes to something like that. There's actually even a thing called the Big Mac Index, which is a chart that shows the gradual price increase of a McDonald's Big Mac around the world, all thanks to inflation. The average inflation rate can range from 2 to 4%. That means that your money is losing 2 to 4% of its buying power every year, which is just wild. That's actually quite a bit. And in the past few years, you may have noticed that inflation has been a big thing, because the inflation rate has been much higher than the average that it has been in the past. Now that we know what inflation is, the best way to tackle inflation is to start investing your money. Now, the safest and probably the most simplest way to invest or slash save your money is to put it into a high interest savings account, which a lot of people do. That's probably by far the safest. There's pretty much no risk involved. You know what interest rate you're getting. Fantastic. The only issue with that is that interest rates aren't actually that great. Right now in February 2024, I think, the average interest rate from a bank might be anywhere between 4 to 6%. However, that rate is probably not beating inflation, or just about maybe beating it. It's not really doing much. Your money is sort of going up in value with the inflation rate, but you're not actually getting that much out of it. But if you're watching this video, you probably want to beat the interest rates that banks have to offer. Before we get into the rest of the video, I also wanted to share an awesome tool called Actionable, who are also sponsoring this video. Actionable is a free productivity extension that uses AI to speed up repetitive tasks, saving me 7 hours of work every week. The templates feature that they have lets you use shortcuts to expand text that might otherwise take time to write out. You can of course make your own templates. So I have one responding to frequent emails I get, so I don't have to manually type it out every time. I also have it for my email address, my shipping address, so I don't have to type those out either. It also has transfers, so if you need to get information from multiple web pages and paste it into a spreadsheet, instead of copying everything manually, Actionable can do it all for you, making data entry an absolute breeze since it's powered by AI. Actionable can of course do a lot more, like AI replying to entire emails for you in a second. The main thing is it's designed to save you time. So make sure to check out Actionable if you want to automate your workflow with AI and boost your productivity. It's free, and I'll leave a link to it down in the description below. So what actually is an investment? So an investment is essentially something that either makes you money or grows your money over time. A good example example of this is buying a house. So when you buy a house, you can rent it out, you can make money from the rental income, and you can of course also make money from the value of the house increasing. So maybe 20, 30 years later, you can also sell that house and get a profit from it there. However, the big issue with buying a house is that there's quite a large barrier of entry, because you need money, of course, to put a deposit on the house. You need to get a mortgage, so you need to show that you can afford the mortgage. You need to pay taxes usually, you need to pay insurance, you need to pay lawyers, and just there's so many other things involved in buying a house. There's just a lot of work when it comes to investing in something like a house. Now, there's nothing wrong with buying a house. If you can buy a house, great. I bought my own place, I love it, it's one of the best investments that I've made. But like I said, the barrier of entry is just very high. For most people, it doesn't really make sense. And even though I have money to buy other properties, I haven't done that. I've actually just put all of my money into stocks and shares into my portfolio, because buying stocks and shares is so much easier and a lot less of a headache. So what are stocks and shares? So stocks or shares are pretty much, in the simplest form, a very, very small sliver of a company. You're buying part of a company. So let's just say you have gone and bought a share in Apple. Now, essentially, you own a part of Apple. Obviously, it's going to be a very, very small part of Apple, but you are an investor of Apple. And like real estate, stocks and shares can also make you money. The first thing which a lot of people will be familiar with is dividends. So there are some stocks and shares out there, not all, but some stocks and shares that will pay a dividend for you owning that stock. So they basically just give you some money based on their profits, based on how much you own of the company. You can then take that money, you can withdraw it, you can reinvest it, you can do whatever you like with it, because that money, they've given it to you. It's now your money. The other way to make money from stocks and shares is the capital appreciation. So over time, if a company is doing well, their stock or their share will go up in value. So for example, if we look at Apple, we can see in the last 5 years the price of their stock and how much it's gone up. So 5 years ago, an Apple share was worth $42, but now it's worth $189. So in the last 5 years, we can see it's gone up by 345%. Now let's do some calculations. Let's just say we invested $1,000 into Apple. So if we times that by 345%, that $1,000 we invested 5 years later would now be worth $3,450. So because we made that investment 5 years ago, it would now be worth that amount of money. That is the capital appreciation. And now if we sell that stock, that's the money we would make. So if we wanted to buy a share in Apple, how do we actually do that? How do we buy stocks and shares of companies? So in the past, if you wanted to buy stocks and shares, you literally had to call a broker, and then they would put the order in for you and they would buy the stock or the share for you. So if anyone's ever watched Wolf of Wall Street or any sort of similar movies, and the way they do it in those movies, that is literally how it used to be done. Thankfully, we don't need to do that anymore. Thankfully, due to the internet, a lot has changed since then. We can usually just buy stocks and shares either from our laptop or from our phone with a lot of apps and services that are available online. There are an absolute ton of apps out there when it comes to buying stocks and shares. I have looked at so many different apps. I've tried many different apps, but I'm one of those people that just wants to keep it simple, wants to keep it easy. I don't want to be dealing with some crazy dashboard that I literally don't understand. And the other issue with those apps is that if you're a beginner, it can be very daunting and very scary. So I've been on the search for the ideal stocks and shares app. In the past, I used to use Freetrade, but Freetrade is only available in the UK, and Freetrade has actually, I feel like, been slowing down on sort of features and functionality. So the one app that I would recommend is Trading 212. Trading 212 is awesome. Like, it basically does everything. And the best thing about Trading 212 is that it's very easy to use. It's not super complicated or anything. It's just very user friendly. The only issue is Trading 212 isn't available in the US. So for my US viewers, I will leave links to other similar apps in the description below. The other reason why I've switched to Trading 212 is that there are pretty much no fees or very minimal fees. Like, it is pretty much free to use. Like, it's actually wild how cheap it is. So I feel like it's a no-brainer for most people. When it comes to what shares you should buy, this is where I can't actually recommend what shares you can buy, because legally I'm not allowed to recommend what shares you can buy. And it makes sense, right? I can't be sort of putting other people's money at risk. That just doesn't make sense. And obviously, like, it's just silly, right? But I can share what I'm personally investing in. I can share what I've already invested in, and that's what I want to do here. So of course, I can go out and buy a share in a single company like Apple. However, that's not something that's really recommended by other people. That's not something sort of financial advisors would recommend, because it's quite risky investing in one company. Now, of course, if you've done your research, or maybe you work in the industry, maybe you work in tech or something like that, and you feel like maybe Apple has some amazing new product coming out, and you feel like, you know, in 5 to 10 years, they're going to be very successful, they're going to have even better products and stuff, then yeah, go for it. You know, you've done your own research. If you think it's worth buying an individual stock of that company, You do you. But most people don't really have that knowledge. Most people aren't keeping up with the industry constantly. They're not seeing what different companies are always releasing. They're not keeping up with earnings and stuff like that. So that's where something like index funds comes in. So an index fund, to put it simply, is a bunch of companies in one fund. So index funds are usually managed by fund managers. A fund manager will get lots of people to invest their money. They will then use that money to buy lots of shares of lots of different companies so that it's diversified, so that it's much safer to invest in the stock market as a whole. The most common index fund that most people will be aware of, and what you've probably heard of before, is the S&P 500. And the S&P 500 is essentially the top 500 US companies in one massive fund. It contains companies like Apple, Amazon, Microsoft. They're all in the S&P 500. This is definitely one of the most widely followed indices in the world, and it's generally used as a good reflection of the overall sort of US economy. Now, of course, it is only tied to the US economy. So you can find funds that are tied to other economies. Maybe you want to invest in the UK economy, the Chinese economy, things like that. You can find funds that do those too. The big reason why they're so popular and why a lot of people invest in things like the S&P 500 is because then they don't have to worry about choosing individual stock. They don't have to worry about individual companies and whether they're going to perform, because they're generally investing in the stock market as a whole in the top 500 companies. They're usually just going to keep up with how those companies are doing. So if we look at the S&P 500 and how much it's gone up by, in the last 5 years, it's gone from 2,700 to pretty much 5,000. So in the last 5 years, it's gone up by 80%, which is pretty decent. That's on average 16% a year, which will of course be any sort of banking interest rate or whatever. That's pretty incredible. 16% a year. Your money is going up in value 16% a year if you had invested it in the S&P 500 5 years ago. But what if we go even further than that? Let's just say we invested in the S&P 500 20 years ago. 20 years ago, the S&P 500 was around $1,000 actually. Yeah, just around $1,000 back then. But now it's worth $5,000. So in 20 years, you would have 5 times your money. So you can imagine, if you had $10,000, maybe you had $100,000, maybe you had $1 million. Let's just say you had $1 million. In 20 years, that will now be worth 5 times that. So your 10,000 would be worth 50,000. Your 100,000 would be worth $500,000. Your million would be worth 5 million. It's pretty crazy, but it just shows that investing in something like this, you're sort of keeping up with the market in general, and you're going to be usually beating sort of interest rates that banks can offer. However, something like the S&P 500 isn't something that you can just sort of trade on an app. And that's where ETFs come in. So index funds and ETFs are essentially the same things, but ETFs are essentially index funds that are available on apps like Trading 212. So it just makes it easier for the average person like me and you to invest in the S&P 500 without actually having to call someone and be like, hey, I'd like to invest in your fund. You can just buy an ETF instead. If you are interested in seeing what I've personally invested in, I have made a list of all of my investments when it comes to stocks and shares and ETFs and things like that. Make sure to check it out. I'll leave a link to it down in the description below. Another thing to consider is fees. So there are always fees involved when it comes to things like index funds and ETFs, because of course there is someone managing these things, right? They take a fee. But when it comes to things like index funds and ETFs, the fees are usually very, very low because they're pretty passive. They don't usually need that much management. They're just quite easy, just sort of sitting in the background. Fund managers for sort of big funds where they're actively managing a portfolio, they might actually charge anywhere between 1 to 5% per year. And obviously they're trying to beat the market. What's funny is that most active fund managers aren't actually beating the S&P 500. Is very few actually beating the S&P 500. So it actually makes more sense for the average person like me and you to invest in something like the S&P 500. There's this great image that I came across showing sort of the investing math when it comes to investing in different things and the fees that some places can take. So two investors both saved $10,000 a year for 40 years. They both invested it in the US stock market, which returned an average of 8%. Investor A invested in Vanguard, which is just a passive index fund, and that fund takes 0.8%. 40 years later, they would have 2.5 million in their retirement portfolio. However, investor B invested in active mutual funds through an investment advisor, and they take 2% a year. And we can see 40 years later, their portfolio is now 1.5 million. So because of that 40-year stretch and the percentage that they charge, 2% might not sound like much, but it can really add up over a long time period. And you can see $1 million in difference, which is absolutely wild. So how long should you invest for? I personally love to see investing as a long-term thing. I'm saving for my retirement. I'm saving for when I get older. I'm not looking to make money very, very quickly. And when it comes to investing in stocks and shares, that's where it makes the most sense. The other benefit of long-term investing is that if there are blips in the market, if the market goes down or whatever, over a long time period, usually those blips won't even matter. You should make money, as we've seen from the S&P 500, the graph that I showed you earlier. Now, what if the stock market crashes? So this is something that some people do say. This is something that people, I feel like, say just because they're sort of scared of it, and I can completely understand that. It can happen. However, if the stock market were to completely crash to zero, something like the S&P 500 were to go completely to zero, that means every single company in the S&P 500, all 500 of them, need to collapse at the same time. That means they all need to be worth absolutely nothing at the same time. If that happens, I think we're going to have a lot of other bigger problems on our hands, because that means that the world itself is collapsing in itself. I don't think money is going to be the issue. I think survival will be the issue. So the stock market, it can obviously crash. It can go down here and there, but it's never ever really going to go to zero, because that means every other company has to collapse at the same time. And obviously that doesn't make sense, because these companies are employing people. They're having money go into the economy. These companies literally help the world run. So if every single company were to collapse at the same time, it just wouldn't happen. It's just not going to happen unless something catastrophic happened. But like I said, that's when survival will matter, not whether your money is going up and down in the stock market. When should I start? So when it comes to investing, the best time to start is today. If you haven't already started, because that's one actually sort of regret I have in life. I wish I had started investing when I was 18. I only started investing, I think, when I was 22, 23, something like that. So there's a good 5 years that I missed there. It's not a big deal. I didn't have the knowledge. I didn't know. But if you're watching this video, today is the best day to start investing. It really is, because the longer you can keep your money invested, the more money usually you will make. And the great thing is you can automate it. Most apps and most services can automate your investments for you. So if you're getting paid a fixed salary every month, you can make sure that part of that salary is automatically transferred to your savings, to your portfolio, whatever you're using, so that then you don't have to worry about it, because then you won't have the urge to spend that money, because you won't see it as like, oh, I've got extra money in my bank account. Knowing that you're putting a fixed amount away every month, every year, whatever it might be, can really help build up that portfolio. How much do you need to start? So thanks to trading apps like Trading 212, you can really start for as little as $10. You don't need hundreds of dollars anymore. And that's what I love about stocks and shares. You don't need tons of money to get started. Like I said, if you can start today, even with $10, $100, whatever it is, whatever amount you have, you're going to be already ahead of a lot of people, because you've made the active sort of commitment to start investing. It's just much easier investing in something like this rather than trying to sort of buy property or buy a business or something like that. Now, of course, those can make you money as well, but a lot of people don't have tens of thousands, hundreds of thousands sitting around to buy property, to buy business. It's why until you get to that sort of stage, if that's what you want to do, one of the best things is to invest in things like stocks and shares. There are, of course, risks when it comes to investing in stocks and shares. Now, I'm going to oversimplify it. This is definitely a big oversimplification, but I like to see stocks and shares as sort of low risk and high risk. Low risk is something like a standard ETF, S&P 500, something like that. And then high risk is investing in an individual company, something like maybe Tesla or Apple. That's how I like to see it. Now, I am currently doing a mix of both because I can. I'm in a position where I can take some risk. So I do invest in individual companies, but I also invest in ETFs and sort of low risk stuff. But the idea is that as I get older, my portfolio will shift, right? So I'll go from sort of high risk to low risk over time. And that's what I want, because as I get older, my years of working will obviously decrease. My years of making money will decrease. So I want to make sure that as I get older, my investments are a lot less riskier. Now, onto some actionable advice to get you started. Paying off debt first. So before you even start investing, it's very important to pay off any debt that you might have, things like credit card debt. Property can be a bit different, but if you have credit card debt, you should try and pay that off as soon as possible. Any sort of finance agreements or anything like that, because credit card debt and sort of finance agreements and stuff, usually they're higher than the percentage that you'd make from something like the S&P 500. So it's in your favor to pay those off as quickly as possible because you'll actually be losing money anyway. Now, of course, some debt can be good debt. Something like maybe a mortgage can be considered good debt, but that's a whole nother topic which I won't get into in this video. But any sort of high interest debt, you should be trying to pay that off as soon as possible. Making sure you have an emergency fund. So an emergency fund is very, very important because you just never know when sometimes you might need money for something. Maybe your car breaks down, maybe your fridge or your cooker or something happens in your house. It could be anything, and you have to spend money fixing it or replacing it, whatever it might be. That's what an emergency fund is for, and it's something that you should have first before investing into things like stocks and shares. Investing in an ISA. So this mainly applies in the UK, but I know they do have similar things in the US and in other countries. And an ISA basically stands for Individual Savings Account. And what it is basically a tax-free investment account. So in the UK, you are able to put up to £20,000 a year into your ISA. So you can have a stocks and shares ISA. You can use that £20,000 to invest in stocks and shares. And any profit you make in that ISA is completely tax-free, which is incredible because in a standard investment account in the UK, that is, when you sell a stock or a share, and if you make profit, you pay 20% tax on any profits that you made. So for example, if you bought a share of Apple for $100 and then 5 years later it is $500, you've made $400 worth of gain. You would then pay 20% of tax on that gain. However, in an ISA, if you had made that gain, you wouldn't pay that tax at all. So ISAs are very powerful in the UK because it's essentially a tax-free way of making money. Once you've done all of those things, start plowing money into your investments. So I like to invest as much money as I possibly can into my portfolio. So any leftover money I have, I try and invest it. I also have a sort of minimum amount that I try to invest because obviously of my job and with the sort of money I make, I'm able to invest pretty much like 50 to 60% of my income. And I always do. Like, it's just one of those things where I think to myself, you know, I want to be able to use this money in the future. I want to be able to grow my money, and the money's sitting there not doing anything anyway. I might as well put it into a portfolio rather than having the urge to spend it on things like cars and all this other stuff that I know I would easily be spending money on, because I do love my cars. I do love spending money on cars. And if I was irresponsible with money, I would have multiple supercars because I just love cars. Like, it's just a silly thing. But trying to be sensible, I know that investing in my future, investing this money into my portfolio means in the future I can have a lot more of a comfortable life. And that's my aim. Investing in my portfolio will hopefully give me a comfortable life later on, so that when I'm retired, I don't have to worry about, hey, can I afford things for my future children, for my future grandchildren, for my family and things like that. This is why I'm investing in my portfolio. So hopefully you guys enjoyed this video. Hopefully it gives you a quick rundown for investing in beginners. I'll leave links to a bunch of resources in the description below. Hopefully you guys enjoyed it. Follow me on Instagram and Twitter and subscribe for more.